Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to try to help you with your retirement. We focus on retirement planning, asset management, tax planning, and we're here to answer your questions. We'll start off the show, of course, with our summary for what we saw happening for the week, but the rest of the show is to be able to answer your questions so you can get farther along in your journey of how to make your retirement, at least in a financial sense, even better. And so you can send those questions in now. We will answer them live. There's two different ways to do that. You can email it to the asktom@talkmoneywithtom.com address here, or put them into the chat box and we'll answer them that way. You can send those emails during the week also. We'd love to be able to answer those and help you out as much as possible. So go ahead and start sending those in. Of course, we are here for your educational purposes. We set up this channel for that exactly. We have over 1,200 videos on here. Go look at those videos. You'll learn a lot about what you need to do for retirement. You can subscribe to the channel. You can hit the bell to get notified when we put new things on there. Look forward to doing that. And of course, you can meet with us on a one-on-one basis if you have, personal questions that you want to ask. You can set up a half-hour, meet and greet time with Eason and I, phone, video, come into the office if you're local, that type of thing. So there's a book appointment button right on our website, right up in the corner. It looks just like that. And we'll be able to meet with you. So very excited today. Hopefully everybody gets something that they can take from the show and go and implement into their retirement. And we get a little bit further down the road and make things work for us here. All right. So I always like to start off the show with a summary of kind of what I saw happening in the market this week. It's actually been a couple weeks since we've had the show. And what a run we're having, really. It's unbelievable. This is, if you look at charts like I do all the time, you don't see as many straight lines on the upside. You'll see those on the downside more because it's kind of a representation of human emotion is what the stock market is. And mostly it's fear and greed. And so greed is not as strong as fear. And so if you look at a chart, they generally kind of go up slowly. And then when something happens, it comes down pretty quick. You can see that pretty clearly on a lot of charts. So you don't have as many, kind of massive upruns that you get like we're getting here. So what that tells you is that there was an awful lot of people sitting on the sidelines, with cash, maybe the big money on the sidelines with cash. And also, in my opinion, probably an awful lot of people shorting the market, at that low point. And, we were just talking before this show, on Friday the 27th, which is the low for this last downturn that just happened, we were, presenting what we saw happening for the week. And we presented the Bank of America survey. They have a name for it, but basically they survey.
I think it's the Bulls and the Bears.
Yeah, they survey the big institutional money managers, and these are the people that probably matter the most. They can really move a market, and they were at their lowest exposure to the stock market in the last 72 years, really at the wrong time, right? And so, and we actually mentioned that might be a good time to buy. Those are usually the signs when you start to see people become very pessimistic and sitting on the sidelines and what have you at high rates. So all that money starts to come back in. You also have another interesting scenario that happens here. So the end of October is when the mutual funds have to sell anything they want to declare as a loss. And so that's kind of a big deal as a fund manager because maybe you've sold a bunch of things at gains during the year and you don't want to pass along some giant capital gain to the clients if you can avoid it. So you start looking for some of the things that you have at a loss. You can sell those, capture those losses to offset those gains. And you can even buy those things back in 31 days. But what that does do is it generates a whole bunch of cash. I just sold a bunch of things at a loss so I can offset these gains. And so you look, that bottom was the 27th of October, and it just started up right after there. Part of that probably is money that was sold off in those stocks coming back into other stocks. They're reinvesting. So you get, short covering happening and then all this cash and other stuff on the sidelines. There's obviously things that happened, as a catalyst to this. But it's sort of like attaching news to a direction, right? I think there's some fundamentals here. There's cash on the sidelines that's coming in. There's short covering and what have you. But the part of the impetus to kind of make it go was the Federal Reserve, not raising rates at their last meeting and having several different interviews where they sound a little softer than they did, for previous times. And the market is now expecting that there will not be a rate increase. And and actually we'll have a rate decrease at this point starting in May. And actually, by December, is the market's expecting a 1.25% decrease, which is pretty aggressive. And we'll talk some about that here in a minute as to how that might happen and what that might mean for the stock market. But this has been just a great run here. I mean, really, really good run. The last show, we kind of had some checklist things so I'll present a few of them again. So we needed to see that trend break, which it did. Good. The last show, we needed to see us get above that little high, which we did. You can see it spent a little time there, kind of dropping, but it did it. We needed to get above that high, which at the last show we did, right? This show now, we actually are today hitting the high for the year. A little over 4,600 on the S&P. We'll see where it closes. I put a lot of emphasis on the close. I think it's important, not just where it got during the day, which I do pay attention to, but I pay more attention to the close. And so it'd be nice to close today at another high. I think this will be the 5th or 6th week in a row that we've had gains. We start off this week, Monday, Tuesday, Wednesday down, all the way, and then started to really move again Thursday and today. So what's significant about today? Oh, one more checklist piece here is important. The all-time high. So go back to, I think it's the 3rd or 4th of January, 2022. Was the high point for the closing for the S&P 500 ever. We're not that far from it. It's a little over 4,800. We're a little over 4,600. So we're within striking distance of getting to the all-time high. I think we're going to go farther here. I think this is a really significant run today in the sense that, we had a little downturn, but it didn't fall apart. They were all kind of light each day, 0.1, 0.2% type downturns. And then we reversed that and we retraced it all within the same week. So that's actually pretty important. So I think we go higher from here. The end of the year can oftentimes be difficult for the stock market just because that's the time frame that individuals like us can start to tax loss, harvest different things. So there's some selling that happens. And sometimes, last year it's exactly what happened. We had a big rebalancing that happened with the funds, right? And then we had this big, downturn for the last 2 weeks, only to be recovered fairly quickly in January. A little bit like what we saw happening here with this. But I do not think we'll get to the all-time high this year, only because I think once we get there, it'll be like touching a live wire a little bit. It'll probably retrace itself pretty quickly, just because there's, probably a lot of sell orders at that point and people that are looking to get their money back. So we call that resistance. There's a resistance there. They're probably going to have to knock up against that a few times, would be my guess, right?
Yeah, and there's only a month left in the year, so it's not a lot of time to make that move.
Yeah, exactly. It's possible if things continue to go the way that they're going that we end up doing that, early next year, which would be kind of fascinating. And again, remembering how amazingly wrong we've been seeing, the articles and the analysts and what have you throughout this time frame. And I've mentioned this before, but it's still very important because it's still ongoing, the concept, which is when you raise rates by 5%, you should have trouble. Something should break, and that should bring down the stock market like what we had in 2000, like what we had in 2008. 45% down in 2000, 57% down in 2008. Those were instances where rates were increased quite dramatically, quite a few times, and market fell, and then eventually something breaks, and then it really falls. So 2008, the break was Lehman Brothers. So this time, the Silicon Valley Bank broke, right? And other regional banks. But the government stepped in with some money, basically, and set up a program, I think that was well designed. And so that's different, right? The money coming from the government wasn't coming from the government the way it is now prior to 2008. So this is a different time frame for the U.S. stock market because partly of that. The other reason that I think the analysts have been wrong is just because of the pandemic spending.
Yeah, there's so much money that came out.
Yeah, there's a lot of money that came out, and there's just a lot of interest, even if they have to borrow on credit cards, right? And so consumers are still going for it. Everybody's got lower, theoretically refinanced homes. The businesses refinanced their debt at lower levels, during that period of time when rates were so low. And we've had really low rates for not just during the pandemic period, but for quite a while there. After 2008, they kept rates really low. So a lot of companies are in decent shape, even if they have a fair amount of debt. At least it's at low cost. I think I remember Apple issuing some debt someplace in the 1%, just below 2% range, a big chunk of it back. That's, it's a lot of debt to have, but it's almost free money.
It's cheap debt. Yeah.
Yeah, and obviously they felt like they could do something with that money and make more than they're having to pay. But so that's the differential here. That pandemic and the government, the way that they're going to try to support the economy by pushing out these different programs. So now what? So how do we get to that all-time high? What happens next year, right? And so this talk that you're going to be hearing about a lot is going to shift from inflation. So we saw several things this week. We continue to see, an ongoing, very slow motion of decreasing inflation, right? And that's been going on for quite a while. It's got a nice path. It's got a nice glide path. So at the same time, we have an economy that's doing quite well. This week was jobs week.
Yeah, so we had ADP earlier in the week that came lower than expected.
Yep. And then we had the big jobs report today, right, which came in higher than expected. Not that much higher. The expectation depends on what you look at, 185 to 190,000 jobs, and we ended up with 199,000. Yeah. Better than last month, which was 150,000, but it's also skewed because you had both the Hollywood actor strike, getting over, and the UAW, auto worker strike. I read someplace that might be 30 to 40,000 people.
Yeah, I think in October they lost 32,000 jobs in auto, and then this month they had 30,000 jobs added.
Yeah, there you go.
So it's kind of like a offset.
Yeah, so you kind of have to look at that, maybe subtract that out, or work that through. But we had wage increase at 0.4% for the month over month, 4.1% year over year. That's not bad, actually. I think that's right in line. Average wage increase is someplace in the 3.5%, but inflation is usually a lot lower than it has been. So if you look at core PCE, the favored measure of inflation by the Fed, it's up 3.5% in the last 12 months. So pay is up 4%. That's a lot better than it was.
Yeah, and unemployment also went down this month, which was kind of unexpected.
Yeah, it really was. I mean, it was up to 3.9%. They consider, full employment at 4%, so still good. And then it dropped down to 3.7%, which was a little bit surprising. This is just all lining up to match exactly what Janet Yellen and the Fed chairman, Chairman Powell, have been saying all along since this beginning. They felt like the job market is strong enough that they might be able to raise rates and end up in this soft landing scenario, which is pretty uncommon. I think the last soft landing scenario was in 1994. And so, you have to take that with a grain of salt. What are they going to say? They're not going to scare people, but they've actually been right so far. As a matter of fact, they've been right for over a year now. And because we are in a soft landing scenario, I think you can't really see, just like recessions, you can't really see them until you're past them to a certain degree.
So it may take a few years for us to consider a soft
landing.
landing.
It's crazy to see how they figure recessions. It's very late. And so I think a soft landing, is something we're going to look back and say, oh yeah, we were there, and who knows where we'll be at that time when we're actually looking back. But so how do we get through that line has a lot to do, and stay above and keep running and not have a downturn next year, has a lot to do with kind of continuing this same concept. So when I see more jobs than expected, the market generally falls. Today it's actually up a little, which is good, because I happen to think that part of the inflationary pressure is because we've shifted so much of our spending from goods to services. So we are seeing reports showing that factory and manufacturing is softening. We're seeing that in China. We're seeing that here in the US. And that, again, is not unusual because we spent so much money on goods when we couldn't do services. And now we can do services, we can travel, we can go out to eat and what have you. But services require more labor, generally speaking. And so more people that get back to work kind of gets that labor more in line as far as that goes. And we are starting to see some normalization of the hiring in that services area. And so I think maybe, some of that pressure with the people really coming out, and probably because things are more expensive. I read an article talking about this New York restaurant, and the gentleman was talking about how, used to get this huge packet of, chicken for $40, and now it's $120.
Yeah.
And of course, they have to pass that along to, their customers. It doesn't make them happy. So probably, at some price point here, people start to look at the grocery store, not eating out as much, and
Yeah,
that's,
you can see just in the price of eggs how it
yeah.
spiked so much, and now it's like fallen so much that a lot of the manufacturers are having issues.
Yes, exactly right. And so that's happening. And so that the job report, I think, continues to show some strength. And the reason that's important is because the conversation that you're going to be hearing about more and more is the recession, the coming recession, which is what we heard about last year. Didn't happen. Doesn't mean they're wrong. Sometimes you can be right and just not have the timeline, right? You're just late. Now, there was a timeline attached to most of the articles I was reading, which is the first half of 2023 was supposed to be a big recession, be down 20% by June, those type of things. None of that happened. I mean, look at, we're hitting a all-time high for the year. We're very close to the all-time high ever. So exactly the opposite of what was expected. So one of the things that is kind of interesting is that the market is expecting a rate decrease.
Yeah.
Okay. When rates are lower, in general, the stock market goes up. When rates start to go down, it can be a mixed bag, right? And so we have one chart here which just shows kind of the Fed rate cuts. They're usually, if you look, those gray bars are recessions. They usually are rate cuts either right during or right before the recession, right? There is one period there in the mid 80s where rate cuts happened without a recession.
Yeah.
And so I wouldn't discount that. I think that's one of the things that this market is confusing people about so much, is we're having some unusual things happen. And again, it's those three things. It's the fact that, there's a pent-up demand for supplies, the fact that supply is coming online, so that's bringing down inflation. And then we have, this scenario with the government being able to step in if they so desire to fix the regional banking system, for example, which is what happened this year. Because I think if they let those regional banks just implode, sort of like what happened with Lehman, we end up with another scenario like Lehman. There was a 30% stock market drop after Lehman folded.
You'd see a lot more banks have fold. It would kind of be like a domino effect. Everyone would be rushing from their money to any of the large banks.
Yeah, exactly right. And, maybe it's good for the large banks, but it's not, it's not good for the economy as a whole to have all these regional banks folding up and people kind of panicking, and nobody wants to take a risk in that environment. So the stock market tends to be a little bit softer and such too. So here's the thing: if you're having rate cuts, and there's a projection for rate cuts starting in May, and fairly significant rate cuts of 1.25% by the end of next year, generally speaking, that is an expectation of some type of recession.
Yeah.
Okay, and the Federal Reserve has a dual mandate, and that is to keep full employment, which means keep unemployment below 4%, 4% or less, and then a 2% inflation rate on core PCE. Okay, so they are maybe responding to job market softness in May. So if you look back, it's a mixed bag. It depends. So for example, in 2000 and 2008, the market had run up quite a bit. They raised rates 19 times for one of them and 21 times for the other. And it really finally, turned into a full-blown recession. We ended up with big downturns. But it wasn't a pandemic. There was no government money that came in early. There was no, pent-up demand spending. So keep those two things in mind. They could offset whatever type of recession. We could have a recession that we don't even realize. Matter of fact, the Bloomberg economists feel like we already started a recession in October by their measure. So, however, we just had 5.2% gross domestic product growth in the third quarter. So, it depends. I actually think, and actually the chief investment officer for Charles Schwab was talking, and she said that basically the manufacturing sector is already in a recession, which I get. I think that's probably quite true. But the other side has just picked up so much that, it's kind of offsetting. It depends on where you're at.
Yeah, I've heard things about a rolling recession in the sense that it goes from industry to industry rather than actually staying with like the entire economy. So you only see areas that will be hit. For example, you can see tech is having heavy layoffs right now, but other sectors are still hiring.
Yeah, exactly. And there was our first little crack in the restaurants. The restaurant business had about 7,000 less jobs on the ADP report. And so again, maybe the inflationary pressures, the high prices of eating out has started to kind of eat into that. And so, but restaurants were booming for a while because everybody was going, and now maybe we're kind of over it, right? We're okay, we've done that. And so it could roll over where we're starting to spend more money on goods eventually, and getting back to that and less on services than we are now. So, and that's what you're talking about, I think, would cause that kind of rolling recession scenario. Again, you might not recognize that. I mean, again, if you're in manufacturing right now, you probably are thinking, wow, what's going on? But if you're not, and you're looking at the overall stock market, it's doing really well. I mean, we are very close to the all-time high, and we just hit today the high for the year. So things are better than people think. Here's one of my things. The stock market is doing everything that it needs to do to prove that it is in a primary uptrend. And it is recovering from downturns. It is doing everything it needs to do. The stock market is a leading indicator. It does not show us at this point any weakness in the economy. The reason the stock market is going up is because the economy is doing well, earnings are doing well. There's some other basic fundamentals for why it goes, but you don't get this close to an all-time high in an inflationary environment unless things are decent. And so it is a predictor of what might happen over the next 6 to 18 months, and the stock market is saying things are okay as far as that goes. So I think this is going to be a really interesting year next year. Has some good potential to do well. There's all kinds of stats out there that show, after a big month like November you'll generally have a positive return in the next 12 months. The average return's almost 15%. I would take 15% from here. That would be really awesome, right? So we'll see how this plays out, but just keep in mind that there are some positive things happening, and that's one of the reasons why the stock market continues to kind of go. So thank you for joining us for our summary here. Look forward to being able to go over this again next week. All right, let's start off with some of the questions.
What is the Goldilocks zone for the economy? What is the ideal economy in the Fed's eyes?
Okay, so that one's actually pretty straightforward in a way, because the Fed is actually fairly simple in its execution. It can get complex, but its mandate is two things: full employment and 2% inflation, right? They don't want to go much below 2%. They don't want to be at 3%. Okay, you don't want to get deflation. So, a ideal scenario for the Fed is to have the unemployment rate be at 4% or less, and inflation at 2%. That's it, right? That's the ideal economy. Now, how do we get there from here? Generally speaking, you end up, normally, you would be raising rates, right? Destroying parts of the economy kind of on purpose, and then all of a sudden employment would go up, quite a bit. Unemployment, sorry. And as you kind of destroying the economy, the prices are coming back down, and you knock inflation down to that 2% level. And then oftentimes you will see that reflexive reduction of interest rates to start to support their other mandate, which is unemployment.
So it's kind of like a balancing act. So you kind of got two things, and you want to kind of have them level out for them. And sure, they have one lever, which is kind of the interest rate.
Yeah, exactly. And I like that. I mean, they're kind of polar opposite, the two goals. And so what they're trying to do is find this Goldilocks zone, so to speak, right? And I think that, it is exactly what they're shooting for here. It's what's happening so far. If you look at what they're doing, they're meeting the mandate. I mean, they've cut inflation in half, essentially, from its high points. And unemployment is still at 3.7%. I think it was at 3.4. So
it's slowly tracking. It's been slowly tracking upwards,
right,
while inflation is coming down.
Yeah, so it's working, and that's why they feel good about where they're at, and why they'll probably not raise rates. They meet here shortly, is maybe next week, I think.
I think so.
And I think it's a 99.4% chance that they'll not raise rates, according to the CME FedWatch tool and such too. So that's an ideal economy in the Fed's eyes, definitely, and we're heading there so far. The problem is that there's this history that the Fed and Chairman Powell's brought this up a couple times in their question and answer, where in the 70s they had this going, inflation was up, they were knocking it down, going along, unemployment comes up, inflation's already pretty far down, so they started to reduce rates, and then inflation got out of control.
Yeah.
And so when they're talking about higher for longer, that's why they're saying that. It's what they're nervous about is reinflating inflation because they got too quick on reducing rates. So I think the market could be a little aggressive on their thought process here of lowering rates that much by the end of next year. I think the Fed is going to stick in there a little bit longer, but unless something breaks or something really slows down, I'd be a little surprised to see a 1.25 rate cut, but it's possible. All right, what's our next question?
So what documents should we keep and for how long? You know, it's the end of the year. You kind of want to start to clean out your closet of all your papers, and what should we be keeping and for how long?
Yeah, we got this question early, so we were able to kind of grab something right off of our website, which is kind of nice. So I'll share that here. So you can go to our website here, Retirement Capital Strategies, and you can see, you know, this nice little visual here. So there's 2 pages of this. It's all one page on the website.
Yeah, it kind of got chopped in half.
Yeah, just to make it so we can see it. But you know, you want to keep, you know, all of your sales receipts until your warranty or the return expires, right? Yeah. So that's a good one. On a 1-month basis, you keep your ATM printouts, and then you can throw them out once you've done your, you know, checkbook balancing.
Yeah, if you still, you know, you can just compare it to your probably to your web portal now at this point.
Yeah.
But if you use a checkbook, you keep it for the month.
Yeah, that's right. So then 1 year, you want to keep pay stubs, your quarterly investment statements, utility bills, canceled checks, credit card receipts, and bank statements. And then we've got some little caveats there. You'd keep the
anything you need for taxes.
Anything you need for tax that has a tax consequence for 3 years. And then once you get your, you know, annual statement, you can compare your quarterly statements to the annual, and then you can toss those and keep the annual, right? And so that's up to a year. And then 3 years, you want to keep your income tax return, your medical bills, and canceled insurance policies, records of selling a house, selling stocks, receipts, canceled checks, and other documents that support your income or deductions for your tax return, right?
Yeah.
And then your annual investment statements.
Yeah, basically anything you're going to use for tax returns. The IRS is going to look at 3 years in the back, as long as you're not fraudulent for your return. So they're just there to support your documentation.
Yeah. And in 7 years, you want any satisfied loans that you've paid off, keep those for 7 years so you can prove that. And then as long as you own these, or as long as they're active, you should keep these documents.
Yeah.
They're pretty obvious, you know, contracts, insurance documents, stock certificates, property records, stock records, records of pensions and retirement plans, property tax records, and home improvement records, right?
Yeah, home improvement you can keep as long as you own the property in case it adjusts your cost basis.
That's right.
So say you added addition to your house and it added the value, but also added to the cost. You want to keep that for the duration of your ownership.
Yeah, that makes great sense. And you know, once you're out of there, probably keep them for a few years after.
Yeah,
just
for
in
your
case
taxes.
There's
Yep.
maybe that 3-year period, so that you can, you know, if the IRS happens to come back and look again too. So, and then keep forever, you know, marriage license, birth certificates, wills, adoption papers, death certificates, records of paid mortgages. So I get asked this question quite often on some of our client strategy sessions, you know, because they're kind of accumulating a lot of different papers, not just, you know, from us, but just from life.
Yeah.
And, you know, how do I keep those? And, you know, you live long enough, you only have so much storage space.
Yeah, stuff has to go after a while.
Yeah, you have to figure out, okay, what do I keep and not keep? And it's one of the more exciting things you do in your life is sit down and go through your file cabinets and figure out how to clean them up. But, you know, unfortunately, we all end up doing stuff like that, or we'll be buried in paper. So good question. There's a great resource here, you know, that you can take a look at as you start to sort through your filing cabinet, so to speak, and, you know, what to keep and what not to keep. And even by category here, because I would be holding these by these categories, at least in terms of the If I have a physical paper, I want to put those in folders. If it's digital, I want to put them in the same folders, but on a digital basis.
Yeah.
You know, my house information or whatever it might be, put it all in one spot so you're not having to dig through the whole thing when you need it.
Yeah, and I'll put a link to this in the description, so if you ever need to grab it, it'll be easy.
Good. All right. What's our next question?
How are qualified charitable deductions or distributions reported, commonly referred to as QCDs?
All right. So qualified charitable deduction, a QCD. These
Distributions.
are distributions. Sorry. These are really popular within the clientele right now. Prior to the 2017 tax law change, they weren't used as often. I don't remember when they became an option, but what they did in 2017 is they raised the standard deduction so high that a lot of people aren't able to
Itemize their charitable deductions.
Yeah, if you can't itemize, then you can't write off your charitable deduction, and you don't need to because your standard is already higher.
Yeah.
But you can still take your standard and still get a reduction of income if you use this qualified charitable distribution. A couple of caveats. First of all, you can only do it if you are getting a required minimum distribution.
No, you don't have to.
Oh, that's right.
So as long it has to come from an IRA,
Right.
whether it's a SEP IRA or a traditional IRA or simple IRA, and you have to be over 70 and a half to do it,
Yep.
which was the old RMD age.
That's right,
So
that's
that's
right.
why it was
Yep.
always associated with RMD age.
Yep.
And you're able to exceed your RMD up to $100,000 is the max though. So if your RMD is above that, you can't go above that.
Yeah, yeah. If you're not taking an RMD, you're giving money away out of your IRA account. You're not getting a write-off for that because you don't have. You're just not having to count that income.
Yeah.
And so it's a way to distribute some money out of your retirement IRA, retirement plan, without having to pay taxes on it and pay your charitable deductions that way. That's not a bad way to do it, especially if you can't itemize. If you are at the age where you're getting a required minimum distribution, that's going to end up on your tax return.
Yep.
Right? So you can give that away, part of that away, anything as far as that goes. So we have some examples here of what some of these tax forms look like, so you get an idea. It's a little hard to see this.
But so no matter what, unfortunately, all your custodians and all your brokers are going to give you a 1099-R, and they're not going to qualify QCDs separate from your gross distributions. So always going to be treated as gross distributions coded as 7. And so that's why you see on this, even though this person took QCDs, it's coded as 50,000 gross and 50,000 as their taxable amount. They're not going to tell you what's been taken out or not. They're only going to tell you what was taken out for Fed and what was taken out for state. That's about it.
Yeah, exactly. So they don't always know for sure, especially if you're writing checks out of your IRA, what you're writing those checks for. They leave that up to you to tell your accountant.
Yeah, and they also you could be writing a check to a friend, or you could be writing a check to. It has to be a qualified charity in the IRSI, which is a
503C. 503C.
A 503C or
Yep. Might be, yeah.
or is it 501C?
I think it's a 3.
Yeah.
Nonetheless, but just box 1, 50,000, right? There was some federal income tax withheld. Box number 4, 5,000, which you can elect to have withholdings.
Yep.
If you wouldn't have withholding on your QCD, but let's just say for the other money that you didn't give away. Box 7, there's a 7 in there, and that just means that it's a taxable distribution, essentially. And even though you might have given away part of that 50,000, they're still saying it's all taxable. We'll show you how to deal with that. There's a little checkbox right next to that 7 there. It just means it's an IRA, SEP, simple IRA. You can't take this out of a 401k.
Yeah.
So this is one of the advantages of an IRA over 401k in this case. So what would happen is that, okay, now here we are, a section of the little 1040 form.
Yep.
You can see IRA distributions on 4A there was 50,000.
Yep.
That's exactly what that form just showed us. And then what 4B
is basically what you actually work as a taxable income amount.
Right. And so you want to put QCD in there.
Yeah.
Just like it's there. Write it in, type it in, whatever. And there's 25,000 taxable. So what that means is that this person gave away the other 25,000 through qualified charitable distribution.
So let's say you gave away 40,000, in that 4B box you would put 10,000.
That's right, exactly. And so And this is a little bit confusing, but it's not hard in the end.
Yeah.
You're going to have your requirement of distribution. That number is set. It's not something you can control. You decide how much you want to give away, and you give it away, and it takes that money right off of your tax return as taxable income. So even if you have the standard, deduction, the high standard deduction, and you can't itemize, you can still reduce your income in this case with your charitable contributions that you might be doing anyway, right? And so this is definitely the smart way to do these charitable contributions. But just like the normal, if you were going to itemize, you'd have to tell your accountant, here's all the charitable contributions I made. This is no different. You're just telling your accountant, here's all the charitable contributions I made, but I took them out of my IRA through a QCD. It's the same thing. You would have to report it one way or another. So it doesn't change anything. It just means that if you're itemizing and you can't write off the charity, and you're getting forced income from your IRA, you could get rid of some of it this way. So it's actually really popular, again, within the clients. Seems to be two ways you can do it. You can fill out some forms and have the custodian do it directly, or you can get a checkbook on that IRA and then write out the checks. Just got to make sure that there's money in the money market for the checks to clear.
If your IRA is invested, you should work with whoever is your custodian to make sure there's enough cash to cash those checks. Otherwise, it'll be bounced.
Yeah, exactly. So that's good info, really. I think that is worthwhile information, that it helps to define this, and more people are starting to discover how this works. And again, it's not that complicated. Once you get to know it, it's a little complicated up front, but it's a little bit of effort, and these type of videos and watching this, and you'll catch up real fast.
So why are bonds and stocks having a positive correlation? I thought it's supposed to be negative. They're supposed to, sometimes go in the opposite direction or have some sort of no correlation.
Yeah, I mean, that question's coming because right now we're having a phenomenal run between both.
It's been a great month if you're a 60-40 portfolio.
Yeah, it was. Wow. I mean, things are really flying. And then last year, I'd say there was a correlation to the downside. Usually when stocks fall, you would hope that bonds are going up, and that didn't happen. Bond had one of their worst years, really, because of an inflationary environment. That's what you're going to get.
Yeah, essentially, when you have high inflation, bonds and stocks tend to have a positive correlation.
Yeah, and I have a chart here. It's pretty interesting. So this is a chart showing the correlation between VTI. So VTI is an ETF through Vanguard. It's called the Vanguard Total Stock Market Index. It is most of the stocks on the U.S. stock market. And then BND is the Vanguard Total Bond Market Index, which is, I think, like 7,000 some odd bonds in there right now. And so it's a great, if you're talking bonds and stock, let's talk about the whole thing, compare those two together. So this little tool here just shows the correlation on a rolling basis, going back, in this case, 5 years. And so correlation is a measurement between one with perfect correlation, so it would be exactly the same, and negative one, which is perfect discorrelation, which would be exactly the opposite. So one's up 10%, the other one's down 10%, right? And so bonds, theoretically, you would like them to be kind of around zero, once in a while maybe be a little negative. I'm kind of happy that they're correlated right now because they're both going up, which is good. But you can see it's kind of fascinating. Look back in that kind of 2014, 15 time frame. It was down to negative 0.3. So they were negatively correlated for a while there. But if you look at the jump here that happened in 2020, it's been pretty positively correlated since the beginning of the pandemic.
Yeah, because bonds had that massive appreciation when the Fed cut rates. And the stock market flew with all the pandemic money coming out.
That's right.
But then when rates kept increasing, bonds kind of stagnated.
Yeah, exactly. So it isn't a perfect correlation. They're two different asset classes. They don't always, go in exactly the right directions. There's other tools that you could use. You can use these different inverse funds and things like that if you really wanted to get more of a discorrelation. The problem is that if you have perfect discorrelation or a lot of negative correlation,
you kind of make yourself flat.
Yeah, exactly. You're losing money on one side. As if you use an inverse S&P 500 fund and combine it with an S&P 500 fund, you're not going to make any money. Basically, they're going to sit there and churn around. There'll probably be some small differential there, might go one way or another. But so the advantage for bonds is that they pay a yield, right? Someplace right now in the 5%-ish area. And so that's kind of nice. You're going to get that if you hold on to it for a year, theoretically. And they can go the opposite direction and or just fall less. Like in 2008, all correlations kind of disappeared. I mean, we had gold and all these things. I saw a great correlation chart with all these major asset classes, and they're going along and they're all over the place. And then 2008 hit, and it was like this barrel. They all got together and went whoosh, but there is a differential. Like bonds were down 10% from high to low, like give or take, and the stock market was down over 50%. So that's still better. But what you love to see is like in 2000, bonds were up roughly 10% when the market was down too. So that's what you really like to see, is kind of that parachute effect. But it depends on what's happening and what type of downturn it is and what's causing that downturn as to how much correlation. In, as Ethan said, in a higher inflationary environment where they are raising rates as much as they're doing, you're generally going to see those two asset classes get a fairly high correlation. And that's what's happened. It's all the way up to what, 0.5.
Yeah, you can see from 2014 to 2020 when, like inflation was low, interest rates were low too, you could see how they were a negative correlation.
Yeah, exactly. Much more so. Right around zero is not a bad place.
Yeah.
Right. I mean, from a diversification standpoint. So, yeah, there isn't any absolutes for the most part in investing. It's what makes it challenging. It's what makes it interesting because it's constantly changing. I think investing in the stock market and bond market is very, very fascinating personally. I just, the dynamics, and it's a lifelong thing. I've been doing this, for my whole life, and I still have interest because it just keeps changing. And there's new things and new ways and new tools, new markets, that are happening all the time. And so I think that's kind of, this is a piece of that understanding. All right, we have maybe chance for one short question. We have something.
Yeah. What should I do with my end of the year bonus? End of the year, a lot of companies are sending bonuses, especially this year, which tend to be a pretty profitable year for a lot of companies.
End of the year bonus. Well, let's see. There, as telling you, there's a 1954 VW Bug in Chandler, Arizona, restoration project. That would be a good investment for a year-end bonus, other than the fact that I think my wife would divorce me if I got another restoration project before I get rid of finish some of the other ones that I've got. So, no, in all seriousness, it really depends on what your needs are. Is that your bonus already baked into your lifestyle, and your bills have to be paid with that? Because that happens. Generally lifestyle grows to the size of the pond, sort of like a goldfish, for the most part. But what do you think?
I think you should there's like an 80-20 split. I'd say 80% you put towards your future, whether it be, paying down debts, investing in, tax deferred accounts, tax-free accounts, or just a general investment account. And then that 20% you kind of, have fun with it. The point of a bonus is it's extra money, and if it's not accounted for in your budget, you should, try and balance that future and the present.
That would be a good recommendation. We do a year-end bonus for the most part, but it's pretty variable.
Yeah.
And I've always counseled, don't count on it, especially since our revenue is predominantly generated by the stock market, which we don't control.
Yeah.
And we might control kind of how we do with that stock market, but not absolutely, right? And I guess I'd be pretty interested to know how you might be able to, if you don't need the money, put that into your 401k shelter.
Yeah, you can talk to whoever your HR department or whoever's running that 401k and ask, I know I'm probably going to have a end of year bonus coming along. Could I have that sent to my 401k? Am I still within the limits? You have to check if you're within that contribution limits, because you don't want to go above that.
Yeah, exactly. So let's say you still had $15,000 that you could contribute, and you're going to get $25,000 in a bonus. Can you go to your company and see if you can get that 15 to fully fund your 401k? Because then you won't have to pay taxes on that 15.
Yeah.
At least for a long time, you can let it grow tax deferred. and the other 10 is now available for other things, some of which might be just to have some fun. But I think that would be kind of interesting to see if that's possible. It's the problem with it is that it's so close to the end of the year often.
Yeah, and it just gets busy.
Yeah, when it's difficult to shove a bunch of money in a 401k, they're much more used to that monthly amount coming in
Yeah.
and not some big lump sum. But it'd be worth looking into if that's something that you're interested in.
Yeah, especially if you know there's a good possibility of it, you can talk to them before it and just let them know this is what you want to do.
Yep, sounds good. Okay, well, that's our show for today. Really appreciate everybody coming. Really good questions today. I thought it was quite nice. So, of course, we are here all the time as a resource for you. We will be here next Friday to do the show. And please send us in some questions now for that next show so we can, get some good questions like we're getting today. Something that you're thinking about that somebody else might be thinking about also. So you can send those in to the Ask Tom at talkmoneywithtom.com. Of course, our channel is a resource. Spend some time on there. We've got it broken down into different playlists and what have you. And you can subscribe to the channel and then hit the bell button, and you'll get notified when we put new content on there. And of course, lastly, if you want to, you can set an appointment with us. Half hour. Go to the book appointment button at the top of our website and schedule something with Issa and I. Phone, in person, video, whatever works best for you. So, look forward to being able to see you again next week. Thank you very much.